Best Canadian Dividend ETF. Which dividend ETF should you own? Hey, what's up guys? Welcome back to DG Capital. This is your premier destination for personal finance, investing, and real estate. For the average Canadian investor, 2020 has been nothing but a roller coaster year. Major stock markets plunging in the spring were followed by some individual stocks surging. Meanwhile, there are other stocks that are still lagging behind. So what are your options? Well, let's find out. As you may know, or may not know, investing in individual stocks is like riding the roller coaster with many ups and many downs. But there are alternatives. One of those options is exchange traded funds, or ETFs. They include a collection of various securities all packaged into one basket. And this basket then trades on any stock exchange. And those ETFs that trade on the stock market are just like any individual stock. They can buy or sell whenever you want. Because ETFs incorporate so many different securities from all kinds of sectors, they are typically not as volatile as a single stock. This is why you may want to invest in the best Canadian dividend ETF to suit your needs. So let's back up a little bit and talk about what are dividend ETFs. A dividend ETF is an exchange traded fund that is specifically designed for investing in a selection of high or growth dividend stocks. These ETFs typically track an index that is designed to replicate a certain benchmark. In this case, dividend ETFs are screened to include strong blue chip companies that are typically considered to be lower risk. They also favor companies that have a history of strong dividend increases over time. The goal for dividend ETFs is to achieve a higher yield than you can find than by investing in an ETF that tracks an index like the S&P 500 or the TSX. Due to the nature of the Canadian market and landscape, all dividend ETFs have a strong weighting in the financials and energy sector. The other prominent sectors include industrials and utilities. And most of these dividend ETFs will also invest in sectors like communications or basic materials to sort of better round the ETF. Later in this video, you'll see what the sector allocation looks like for the three ETFs I want to talk about in this video. Should you be investing in dividend ETFs? Now, whether investing in dividend ETFs makes sense for you will depend on a few factors, such as your lifespan, your time horizon, your risk tolerance, and other such factors. Now, generally speaking, dividend ETFs are for risk-averse investors. These investors are not going for those big moonshots. They want steady, stable income that they can count on a monthly, quarterly, or any other periodic basis. For example, investors who are retired or maybe are approaching retirement may want that stable income that they can count on that comes from high yields in order to support their lifestyle. Dividend ETFs can help sustain that lifestyle when you're no longer working and don't have that salary income that you can bring in. Or maybe you're shooting for early retirement, and if you've built a portfolio of dividend ETFs that can sustain your lifestyle for the years to come, then maybe you don't even need to work and call it a day. For investors who are hoping to keep more of their hard-earned money in their pockets and they want to take a hands-off approach to investing, ETFs are especially attractive. Not to mention, expense ratios are much lower than your average mutual fund. A good dividend ETF can save you time and effort from researching countless individual stocks with much better diversification. If you're looking to make a quick buck and you're constantly going in and out of the market, buying and selling stocks, then ETFs, they're not for you. But if you want a reasonably reliable investment that's known to produce steady income, then one of these ETFs I'll be presenting in this video might be a good option for you. But you might be thinking, are dividend ETFs a good investment option? Before you invest in anything, it's always a good idea to do some homework yourself or work with a financial advisor that you trust that can help you narrow down your options. For example, for dividend ETFs, maybe you want to speak with a financial advisor if one of these investment options is right for you. And no matter who tells you this, but there is no guarantee of future performance. So if someone's telling you that this investment will generate 12% return or 13% return, that may not actually happen because of how the stock market actually works. Because there is no investment that guarantees any return. If that's the case, then how should you select which ETF makes sense for you? Well, take a look at the ETF's diversification. Does it have good sector diversification? Does it have a strong background of producing returns in both good and bad times? And the most important thing you should pay attention to, does it have low fees so it won't eat away at your return? Remember, the lower fees the ETF has, the more money goes into your pocket. The thing you have to remember is that when you invest in a Canadian Dividend ETF, and because financials make up like 1/3 of our market, that ETF you choose will have a huge weighting in the financial sector. When deciding between dividend ETFs, take a look at the diversification. Does it only have like 10 stocks, or does it have 50, 60 stocks in its holdings? How's the MER ratio? Which one has the lowest MER ratio? And look at the history of dividends. Has it been known to producing stable dividends over time? Or the dividends spike up and down based on the market? Now this is the question you've been waiting for. What is the best Canadian Dividend ETF? There are 3 dividend funds that stand out for me as being the best Canadian Dividend ETF, and they are the iShares Canada Select Dividend ETF, known as XDV, the BMO Canada Dividend ETF, known as ZDV, the Vanguard Canadian High-Dividend Yield Index ETF, known as VDY. There are other dividend ETFs available in the marketplace, but these are the 3 that I pay the most attention to. Now, in no particular order, let's take a look at the iShares offering, or XDV. Now, this ETF seeks to replicate the performance of the Dow Jones Canada Select Dividend Index. This dividend ETF is managed by BlackRock Asset Management. Its goal is to create long-term capital growth by investing in 30 high-yielding Canadian companies in the Dow Jones Canada Total Market Index. This index offers a large exposure to the financial sector, and it pays a monthly dividend. This fund is the largest of the 3 ETFs I have, and it has a net asset value of $1.2 billion. It has MER fees of 0.55% and currently yields 4.45%. XDV is known to be a top performer, and it carries a risk rating of medium. The financial services sector is heavily weighted in this portfolio, with strong representation from Canada's big banks. In smaller percentages, the fund also has investments in communications, services, and utilities. For those wanting the chance for higher dividend returns, weighted against a slightly higher risk factor given the concentration of sectors, this may be a good fit. You can see the top 10 holdings, which includes RBC, TD, Enbridge, Bank of Nova Scotia, TC Energy, and more. Next up on the list is a BMO Canadian Dividend ETF, or known as ZDY. This ETF has net assets of just over $470 million, and in my opinion, will suit investors with a slightly higher risk tolerance. This fund focuses on dividend yield and targets companies with a top dividend payout, and also for some capital appreciation along the way. This ETF is designed for investors looking for a balance between income and capital growth in their portfolios. This fund has better diversification than the other 2 on the list, but still has a large exposure to the financials and energy sector. Stocks in this ETF are assessed based on 3 particular factors: dividend growth, yield, and payout ratio. ZDV pays a monthly dividend, has an MER of 0.38, and has an annualized distribution yield of 5.13%. You can see the top 10 holdings. It includes Power Corp, Nutrien, Bank of Montreal, Sun Life, CIBC, and so on. Last on the list, VDY, the Vanguard Canadian High-Dividend Yield Index ETF. The Vanguard FTSE High-Dividend Yield Index ETF seeks to track, to the extent reasonably possible and before fees and expenses, the performance of a broad Canadian equity index that measures the investment return of common stocks of Canadian companies that are characterized by high dividend yield. This ETF has net assets just north of $603 million. VDY pays a monthly dividend, has an MER of 0.22%, and an annualized distribution yield of 5.42%. This ETF has the highest exposure to the financial sector compared to the other two on the list. Because of that significant exposure to the financial sector, this dividend ETF has the highest yield among the three, but also the lowest MER ratio. You can see the top 10 holdings, which includes CIBC, Canadian Tire, Bank of Montreal, Royal Bank of Canada, Bank of Nova Scotia, and so on. Notice the names of the top 5 holdings for this ETF. 4 of them are Canadian banks. Let's face it, it's no secret that investing in today's market is filled with uncertainty and challenges. We should note that given the impact of the coronavirus pandemic on the worldwide economy, the typical performance of many sectors and investments has been negatively impacted. High dividend paying ETFs in Canada are no exception. Just look at the performance of the 3 dividend ETFs that I talked about in this video. They're all down by at least 10%. It's important to look at the history of each ETF to get a full view of the performance over time, because you don't want to see how the ETF performs in just the good times, so you'll be surprised in the bad times. You want to know how it does in both the good times and the bad, so you can make a better decision if this investment is an option for you. There are general formulas that advisors have come up with to help guide investors make investment decisions, such as having low-risk investments as a percentage of your portfolio equal to your age. For example, let's say you're 60 years old. That means 60% of your portfolio should be geared towards low-risk investments. The theory is that these low-risk investments help smooth out returns over time. You'll get lower returns over time, but with much less volatility compared to high-risk investments. But these are just rules of thumb, and they may not be applicable given our uncertain economic times. In unprecedented economic times like we have today, it might be just better to sit down with a financial advisor and talk to them about the best way to move forward and what makes sense for your situation, because your next steps will depend on assessing a variety of factors, such as your risk tolerance, your stage in life, your investment preferences, and ultimately, your goals. Now let's look back at the 3 ETFs and see which one makes sense for you. When looking at all 3 ETFs, we can see that XDV from iShares has the highest net assets and the highest MER. And this MER simply means that if you have $1,000 invested in this ETF, $5.50 gets deducted from your total return in order for this fund to be managed on your behalf. In terms of cost, VDY from Vanguard has the lowest fees with an MER of 0.22. VDY also has the highest yield compared to the other two. When looking at the number of holdings, ZDV from BMO has the most individual stocks within the ETF at 52 holdings, and XDV only has 32 holdings. All 3 have the same level of risk, which is considered to be medium. When looking at the top 10 holdings, ZDY appears to be the most balanced, as the top 10 stocks make up 30% of the fund's weighting. Compare this to VDY, where the top 10 stocks make up 72% of the fund's entire holdings. If you're looking for a well-balanced fund with a reasonably priced MER and a dividend yield of over 5%, ZDY could make sense for your portfolio. On the flip side, if you're looking for a dividend ETF that focuses on the financials and energy sectors and has the lowest cost in terms of the MER, then probably your best choice is VDY. Navigating the dividend ETFs depends entirely on what you're looking for as an investor. If you're strictly looking at income versus capital appreciation, then your approach may be different. Care should be taken when choosing ETFs based on their style, their diversification, their past performance, and definitely fees. Because past performance does not indicate or guarantee future returns, it is good practice to make sure you pick from funds that have established a decent history. You could also go for funds that have the lowest management fee and a good amount of diversification. Because returns are not guaranteed, but at least having lower fees puts more money in your pocket. A good ETF investment option will not only save you time and energy from researching countless individual stocks, but also provide far better diversification. And that's it for this video. Thank you so much for watching. So make sure you hit that like and subscribe button to continue to get the latest news on personal finance, investing, and real estate. Make sure to leave your thoughts and comments down below. And I'll catch you guys in the next one.